Are you thinking about buying a short-term rental but worried about making a costly mistake? You're not alone. Every week, I hear from new investors who are thinking about investing in short-term rentals but are stuck in analysis paralysis because they're worried they're going to get stuck with a property that drains their time, their bank account, or even worse, both. So in this video, I'm going to walk you through the most common traps I see first-time short-term rental investors fall into, and more importantly, how to avoid them so your first deal sets you up for success, not stress. Now, if you're serious about getting this right the first time, this video is for you. And toward the end, I'll also share a tip for how to not only avoid a costly mistake, but turn it into a win. Imagine going from thinking you're going to lose money to actually making money. You're not going to want to miss this tip. If we haven't met yet, I'm Kenji from Semi-Retired MD. My wife and I help high-income earners build wealth through real estate, and short-term rentals are one of the most powerful tools for building wealth because they can not only generate a significant amount of income, they can also be used to lower your taxes. If you don't know what I mean by short-term rentals, here's a quick primer. Short-term rentals are homes that you set up for short stays. You use platforms like Airbnb and Vrbo where guests can book a stay at your home. In the US, they come with significant tax benefits as long as your average stay is 7 days or less and you put in enough hours operating the property to qualify. Many high-income earners are drawn to short-term rentals because of the tax benefits. It's one of the few ways for a high-income earner to significantly reduce their taxes while continuing to work full-time. But time and time again, we see people rush into short-term rentals without taking the time to learn how to do it the right way. The result? They make mistakes and end up losing money in the end. So what are the most common mistakes we see? I'm going to cover 5 of them, starting with the most common mistake, the one that usually becomes obvious only after the first few months of ownership. Mistake number 1, accepting too little cash flow. This is the most common and probably most painful mistake I see new investors make. They settle for too little cash flow, or sometimes they end up with negative cash flow. Short-term rentals can absolutely be lucrative, but only if you know what you're doing. And that starts with buying the right property in the right market. What I often see is this. Someone finds a nice looking property, maybe in a trendy neighborhood or a popular vacation town, and they assume it'll perform well. But the problem is they haven't run the numbers. They haven't compared it to the competition. They haven't factored in seasonal slowdowns. They get hit with unexpected expenses. And what happens? They buy the wrong property. One that blends in instead of standing out, one that gets buried in the listings and struggles to get bookings, especially in the off season. I've seen investors in this exact situation. They thought they were making a smart move, but a few months in, they realized the cash flow is razor thin, or maybe they're losing money. And when unexpected expenses hit, a repair, a slow month, a refund request, they're in the hole even more. That's a stressful position to be in, especially when your goal was to build passive income, not babysit a property that's constantly draining your finances. So how do you avoid this? Start by aiming for strong cash flow from day one. Use tools like a deal analyzer to break down your income and expense projections, not just in the peak season, but year-round. And focus on properties that outperform the market, not just blend in. In a minute, I'll show you how this mistake connects to another one that's even harder to recover from: overleveraging. But first, let's wrap up this one with a takeaway. Don't settle for just okay, because in short-term rentals, cash flow is your lifeline, and without it, that dream property can turn into a financial nightmare. Mistake number 2, over-leveraging yourself. Now let's talk about leverage and how easy it is to get this wrong. Most people don't know this when they're just starting out, but you can get into a short-term rental for as little as 10% down using a second home loan. Now, it can feel like a win to get into a deal with just 10% down, but here's the trap. When you rely too heavily on low money down loans to acquire multiple properties, you put yourself in a very precarious position. I've seen this firsthand. One investor I work with bought several high-end short-term rentals using 10% down loans. It seemed like a smart way to grow quickly until demand dipped and booking slowed. Suddenly, she had several large mortgages to cover, very little equity to fall back on, and no financial cushion. She was stuck. So how do you protect yourself? Be strategic. Just because you can use low down payment loans doesn't mean you should. Keep an eye on your leverage. Build equity intentionally. One way we like to build equity is through forced appreciation, improving a property to raise its value and increase cash flow. That might mean adding bedrooms, upgrading kitchens, or reworking the layout of a home. These value-add moves can help you go from 10% equity to a lot more, and that can make all the difference when the market shifts. We'll circle back to some ways to compete in the market later in the video, so keep watching. Mistake number 3, letting the tax tail wag the dog. Here's a mistake I see all the time, especially with high-income earners. They let the tax tail wag the dog. They get so focused on the tax benefits of short-term rentals, they forget the most important thing: buying a great property. Yes, the tax advantages are real, they're powerful, but if the property isn't in the right location, doesn't cash flow, or can't compete in the market, those write-offs won't save you. Let me give you a real example. A friend of mine jumped into a deal purely for the tax benefits, but as soon as the deal closed, the problem started. The location was wrong, bookings were weak, and after expenses, he was losing money each month. The tax deductions didn't fix the fact that the property wasn't performing. So here's a simple rule: buy a great property first. Focus on strong cash flow and build equity through forced appreciation. Because if it's a solid investment, the tax benefits will follow naturally. But if you ignore the numbers just to chase write-offs, you're setting yourself up for disappointment and maybe even losses. Mistake number 4, falling behind the competition. Let's talk about where the short-term rental market is headed. The short-term rental space is evolving fast, and what used to work, even just a few years ago, might not be enough today. Gone are the days when a basic listing with IKEA furniture and nice photos could generate a lot of cash flow. Today, we're seeing short-term rental funds and large corporations enter the space with big budgets and big ambitions. They're adding amenities like lazy river pools, movie theaters, and even regulation-sized pickleball courts. They're optimizing guest experiences down to the smallest detail. And if you're not evolving your property, you risk getting left behind. I've seen this play out in real time. A property that performed well for years suddenly starts to lag, not because the owners did anything wrong, but because the competition raised the bar. So how do you stay competitive? Study the local market regularly. Check nearby short-term rentals and see what they're offering. And then reinvest in your property, whether it's through better design, upgraded features, or enhancing the guest experience. The short-term rental game has changed. The industry is professionalizing. To win, you're gonna have to keep improving. The more you improve, the more you'll stand out in the marketplace and maintain that competitive edge. Mistake number 5, not having a backup plan. All right, this is the last one, and it's a big one. Every investor should ask themselves this question before buying. What's my plan B if short-term rentals stop working in this market? It could be a regulation change, a drop in tourism, a platform policy shift. We saw this in real time during COVID. I know a couple who bought in a popular vacation area. Soon after, the city passed a temporary COVID ban on short-term rentals. The city said it was temporary, but eventually they made the ban permanent. So what happened? This couple didn't panic because they already had a plan B in place. Their plan included smart upgrades to the home, adding a pool, they made amazing interior upgrades, and forced appreciation on this property. This allowed them to reposition it. They bought it for $650,000, upgraded it, and then sold it just a few months later for $1.3 million. That kind of pivot is only possible when you have a backup plan and enough value in the property to give you options. Whether your plan B is to convert it into a long-term rental, mid-term rental, or selling after a strategic renovation, make sure you're not depending on only one path for the property to succeed. Flexibility is your safety net, and in a market that's constantly changing, it could be the difference between a win and a costly mistake. Real estate investing can be an incredible way to build wealth, but you need to approach it with the right mindset and strategy. Avoiding these 5 mistakes won't just help you avoid costly problems, it will also help you build a portfolio that's sustainable, scalable, and profitable. And if you're serious about mastering short-term rentals, I want to invite you to check out our Accelerating Wealth Short-Term Rental Blueprint course. This course is specifically designed for high-income earners who want a step-by-step blueprint for profitable short-term rental investing. Don't waste time piecing together unproven strategies or relying on risky guesswork. In our course, you'll get expert guidance and a proven roadmap that will help you avoid costly mistakes and set you on the path to financial freedom. This is a blueprint for success, no luck required. Now, if you're ready to take the next step in your investment journey, click the link below to learn more about our Accelerating Wealth course. Thanks for watching. If this video helped you catch a mistake before it happened, hit like, subscribe, and comment below with your biggest takeaway. And remember, your first property sets the tone for everything that follows. Let's get it right the first time. See you in the next video.